usually people want something fixed or complaining about something. And so it's tough, and you got to make sure that they feel appreciated.
This podcast is for educational purposes only. Nothing you hear on this show is legal or investment advice, nor is it an offer to buy or sell securities. Always consult your own legal and financial professionals before making decisions. Welcome back to another Capital Flow podcast. I'm your host, Dallon Schultz, and we got an incredible guest with us. Gary and I actually go back. It was
2018.
2018. It's
crazy,
wild. So we had a unique event here at our office, invite only, and Gary came in from Los Angeles. So we said, hey, while you're in town, let's shoot a podcast. So look, if this is your first time joining us, appreciate you being here. If you're looking to raise any amounts of capital, typically $100,000 or more for real estate, for business, for any venture that you're after, then this is the show for you. So we bring on experienced business owners, operators, people that have raised often millions of dollars previously. And not to toot Gary's horn too much, but he's going to get into his experience. But over the last 6 years, he and his team with partners have raised over $100 million for their real estate projects. So really excited to have him here, and we're going to get right into it. So Gary, appreciate you being here with us.
Yeah, thanks for having me. Great event, and appreciate all the work that you've done for helping us raise more capital.
Yeah, that's what I love about business, especially commercial real estate. You find it's a team sport, and you find people that you trust, that we've known each other for 7 years. Yeah. And then you find ways to provide value. So yeah, it's been a blast. So Gary, share with our listener a little bit about who you are and how you got started. I mean, you've raised a significant amount of money just in 6 years. So what got you there?
Yeah, I mean, I was an entrepreneur really from an early childhood, and I co-produced a low budget film in my 20s, and I had to raise money for that. But and the first deal we did for a syndication, I raised $100,000 and absolutely sucked at it. It was such a struggle, and it was just very uncomfortable for me. Like, I hadn't done any deals before that. I had invested in other people's deals, but and I just sucked less and less each time I did it, and just learning ways, building systems and whatnot. And they always say build the systems before, and I hadn't, because I just wasn't sure about it. And so not until I started doing that did things start going better and better and better,
I remember the first real estate deal I raised for, it was only $25,000, and I was terrified. What do you think it is about that first raise that you have to go through that makes it so difficult and challenging?
Yeah, I guess, we haven't done it enough to realize all we're doing is sharing an opportunity. If someone wants in, great. If they don't, no big deal. But when you start having that mindset, someone's going to come in. Maybe it's the first deal or the third deal, or people have been watching me for the 8th deal, and they finally come in, or the 12th deal. It's a long game, and if you look at it that way, then it's much easier. But it's just having confidence in that responsibility of returning someone's money and making sure they got a nice profit. And it's a huge responsibility. And if you're not nervous, then maybe this isn't right for you, because you're just, you need to have that understanding that it's someone's hard-earned money that you're taking, and you better do right by them.
Yeah. And I think that's really important to highlight. Like the people that you and I work with, these are everyday people. They're investing with sometimes their IRAs. They might have $50,000 in savings. Like these are everyday people that are looking to try to improve their lives. They want to get into real estate, but they don't know how, or they don't know or want to get into all the management side of it, which is one of your specialties, and we'll get more into that. But when I look back at the first capital that I ever raised for real estate, for me, I realized it was a mindset thing, and you said it perfectly. You're inviting them to participate in these deals with you. You're not selling anything. Like, you're selling, but you're not selling, if that makes sense. And if you're inviting people and you truly believe that this deal will help their financial future, then why wouldn't you invite everyone to participate, everyone that's qualified to participate in it with you? So for me, it was a big mindset shift. Did you experience something similar?
Yeah, absolutely. And being able to tell people, like, I'm one of our biggest investors in all of our deals, and our whole team invests, like, we are incredibly aligned, and the way we do our waterfalls too, like, we want to make sure, like, hey, this is very investor friendly, because I know as a passive investor in other deals, I want my money back first too.
Yeah.
So, I really wanted to understand the process and come from it from the investor side, and that was really important to us.
Yeah, 100%. So, talk to us about the first deal and in 2019 when you decided to go all into this business. Talk about that first deal, how it went, some of the challenges, things that went good.
Yeah, so definitely struggled trying to get that first deal. That's like the hardest thing. Once you get past that first deal, then brokers are a lot more friendly. And so we were focused on the Phoenix market, and the guy who I partnered with by meeting him at a meetup and seeing that he kind of had the same work ethic and was driving to Phoenix and Tucson like me from LA. We partnered up, and we bought this rundown apartment building that kind of looked like a motel, 42 units. We paid $1.65 million. We probably should have bought the whole block at that point. And we were able to basically double rents, and almost everyone stayed because it was so under market, the rates. It was insane. We did not predict that. They had the wrong phone number on the wall for, like, if you wanted to rent the place, like, that's a number one problem right there. And it just needed some love on that property. So they had like glass sliding doors as your front door, which was really insane. But we fixed it up. We didn't spend that much, but just a few $100,000 to fix it up. And we really finished our business plan in the first year. And so what we tried to do was create more value add. So that was a big thing in multifamily, create enough meat, leave enough meat on the bone for the next buyer. So we added like a platinum level where we did a backsplash, and I spent a little bit more money to create some more value for the next buyer. And so we sold that after 2 years and returned investor, I think it was like 1.7. So if someone invested $100,000, within 2 years they got 1.7 back.
That's insane. So 170,000.
Yeah.
Yeah. So they got it $70,000. So $35,000 a year basically. With
Yeah.
Insane.
Yeah.
Good old times, huh? Where are they now?
Exactly. So
how much did you have to raise for that deal?
So we raised $1 million. I personally only raised 100,000.
Okay.
Or 105. 3 people at 35,000 each. It was just some guys I knew. One from volleyball, one from the real estate world, and I forgot who the third investor was, but and then we had some nice cash flow, some tax benefits in it. But yeah, it was a struggle because I didn't have an email list I was sending out to on a monthly basis. It was me getting on the phone and reaching out to people in the beginning, and then once I finally closed the deal, I'm like, okay, now all the things they told you about building those systems, I really need to do it so that I could be prepared for the next deal.
And that first deal being $1 million, to some people listening, that might seem like a lot. It might seem like a little. It just depends on where people are at in their journey. But what I want to highlight is raising capital. Well, first and foremost, this, like, before you raise capital for anyone, talk to a securities attorney, because there's rules around it. There's compliance, and but raising that capital, whether it's your first million or your second million, at some point you're going to tap your network. And what we have found is that we have a user on our platform. He's raised $80 million personally himself over the last few years from his network, and then it just came to a screeching halt because he fell into a similar trap of not having those systems in place. So what are some things that, looking back at your first raise versus to what you have now, what are some things that your team is doing now that you feel like is really helping move the capital raise along?
Well, it's engagement with potential investors. So we're, really making sure everyone gets on that list that wants to be on that list. Obviously, people can unsubscribe or get off the list if they want to, and providing educational content. And we didn't do that in the first few years. But every month we pretty much have some kind of webinar, whether it's on taxes, on bonus appreciation, on the latest, market updates, whatever it is, case studies. We're educating them so that they are more qualified and able to make a better decision when we have an offering. And so it's staying on top of mind, because I can't tell you how many investors I've lost because someone else was there when they had the money in their pocket for that 5 minutes. That other person had a deal at that opportunity and I didn't, and that person went to someone else because they think it was easy to do, and they weren't focused on the quality of operators, just that their money was burning a hole in their savings account and they've got to invest it somewhere else. And I think people have learned the lesson over the last few years about that.
For sure. Anyone that's raised capital has been in that situation where they've lost out on an investor, and you learn real quick what you need to do and what you need to have in place. For us, it was a $200,000 investor. He's soft committed. He's like, guys, I'm in, like, verbal commit. We got it. We didn't have a deal at the time. So we said, hey, when we have a next deal, are you good? Yep, I'm good. Let me know. We went cold for 3 months. We went cold. Yeah. We didn't do anything for 3 months because we didn't have a deal. We're looking. We found a deal. Call him up. Hey, James, you interested? Dallon, I wish you called me 2 weeks ago. I just wired $200,000 into another opportunity because I forgot that we had talked about this. Yeah. And I'm like, forgot, dude. We had multiple calls. Like, for us, it was fresh in our mind. But I think it was a good learning lesson for our team to realize people are busy. Like, yes, we have an opportunity. Yes, we're confident we can serve them and help them. We invite them to be a part of it, but they have lives too. And so if you're not top of mind, the reality is somebody else is. Yeah. And you've lost capital that way. We've lost capital that way. And we found that people can really raise their first, I'd say up to like 5 million typically on bootstrapped systems. And then they realize they got to do it more efficiently. And for you guys, I think those webinars are a great way, because now you have a very non-invasive, I don't even want to say confrontational. It's just an invitation. It's a nice invitation to say, hey, if you're interested, we're actually having this webinar talking about tax benefits. The beautiful thing is, you and I don't have to be the one giving the webinar. Right. You just invite an expert in. And so I think that's a great move that you guys are doing. And it's just nurturing. People aren't ready to invest after they have one conversation with you. So as you guys have gone through that process, you've implemented some webinars. Have you guys been able to identify key metrics or steps or things that these people need to go through before you're pretty confident that they're going to work with you?
It's funny. Everyone is different. And once we feel like we figured it out, then we figured it out that we haven't figured it out.
It's like kids. You have kids, right?
Yeah.
Yeah. We got 4 little kids, and you're like, okay, we finally figured out with the first one. And the second one, you're like, who the hell is, like, this is completely different. Yeah. So
it's funny. I have one investor. I never even spoke to him. We were doing a 506C. He saw my name. I spoke at a conference on the East Coast, and he's like ready to like wire in his money and whatnot. And we're like, we can have a conversation first. Like, I want to make sure you understand the deal and know that there's a lack of liquidity. And I want to make sure you know what you're investing in with me too. Whereas other people, we might have spent hours, on the phone with someone, and they've gone to a bunch of webinars and whatnot, and then they're finally coming in. So it's funny, everyone is different, but yes, if we see that they're engaged, attending webinars.
Hey, Dallon here. I have a special invitation for you right before we get back to the show. If you're out there raising capital or trying to, here's the truth. You don't need more calls. You need better ones. That's exactly why we host weekly capital flow workshops. Every single week, we bring in experts who show you how to generate more investor leads, accelerate trust in half the time, and pitch without pressure. It's not theory. It's what's working right now for active capital raisers in the trenches. No need to do this alone. Go ahead and click on the link in the description or the show notes below to make sure you don't miss the next workshop. Who knows what new idea or strategy could lead to your next investor. Join us live every week and plug into the flow. Click the link below to join us. And now let's get back to the show.
Opening up our content, then they're more likely to invest.
Yeah, 100%. It's funny that you brought up that guy that just wanted to send you money. You and I, we get nervous about that. When somebody's just ready to send you money, you're like, no, like, and the reality is it's a partnership. And the types of deals we do is they're typically 3 to 5 years. And so if somebody is that quick to wire money, don't be so quick to accept it, because is the alignment even there? Like, are they aware of everything? So I really appreciate how you're like, whoa, pump the brakes. Like, let's have a conversation first. And for some people listening to this, they may not have realized how important that is. If somebody's just throwing you $350,000, why wouldn't you take it?
Yeah.
This is why you don't take it.
Yeah.
You got to make sure that alignment's there. And let's pivot a little bit into that, because one of your superpowers, Gary, is the asset management piece of the deal. So I know this podcast, we talk about raising capital, but some of the people that I know that have raised capital the most effectively and efficient way are very, very good operators, strong operators. They have that track record. And not only do you have that management experience, but you have an ability to see the potential in a property and determine what you need to do to increase that value. And that's what your whole business model is built around. And being able to do that consistently and effectively, I'm assuming, is what's led to part of your ability to raise $100 million over the last 6 years. So let's talk about, for this guy example, that was going to send you $350,000. If somebody calls you up and says, hey, I want to send you money, what's your typical process? What type of things do you talk to them about to ensure that they're working with the right operator?
Yeah, for us, we want to make sure, one, they understand the deal. Like, knock on wood, we've never had an issue from one of our investors because they fully understand what they're getting themselves into. And number one is that liquidity piece. When they invest in a deal, it's, we say it's typically going to be a 3 to 5 investment, but we want to make sure you don't need this money for the next 5 years, you know. 2, is this your last piece of money? Like, if your kid is going to college next year and you're counting on enough cash flow or whatnot from that investment, maybe this isn't the best deal for you or whatnot. We want to make sure they understand the difference between pref and cash on cash, because a lot of people get confused on that. We want to make sure they understand the tax benefits that, so if someone invests right now $100,000, they might see anywhere from a $85,000 to $100,000 loss on their K1, but not everyone could take advantage of it. Certainly, you could carry it forward if you're using your self-directed IRA. Again, it's not gonna really affect you that much, but we just want to make sure they fully understand all the key elements, because what you say and what they hear could be two different things. Yeah. So that's just very, very important. And that's just that alignment again between investors and us, and making sure, there's just not going to be any questions down the road. And that brings, they're going to tell their friends that, once they see success, and bring in other people. And that's the number one way for us that we've grown our investor base.
Is seeing success,
and then other people telling their friend about it and bringing them in.
Yeah, having that strong referral network is huge, and that can be challenging sometimes, especially in the deals we do, because if you do hold it for 5 years, people might be hesitant to refer a family member because they don't know how that deal is going to turn out. So fortunately, the few years you got in, the first few years allowed you to turn some of those deals. But yes, the market had a play in it, but Gary, you're still successfully operating deals even in the market and the economy that we're in. So invite us into that world a little bit. Invite us into the asset management and how you and your team really structure and set up these deals in a way that you feel confident and comfortable inviting more people to participate.
Yeah, it all starts in your underwriting, quite honestly. Like, where is that potential? Going through the T12, so the last 12 months of their P&L, basically, putting your eyes on the property. Where's, is there good retail? Is there bad retail around there? What are the other comps and their rents, and just trying to find value. Where else can we add? Are there amenities we can add? Are there other income lines can we add? Finding that's where it all starts. We've averaged across our portfolio a 40% bump in NOI in the first 12 months up until all of our deals until the last two, where we knew that it was more of a basis play versus a value add play. But that was a huge rocket fuel for these properties. Whether we exited in a couple of years or if we even, like in 2022, probably overpaid on a few deals, but at least that ability to really kick butt on the operations side has bailed us out quite a bit, and it's also from the underwriting piece to take over and really staying on top of our property manager. So we have our consistently weekly calls. We do consistently monthly property visits, and sometimes we'll do things unannounced, and we'll just come, whether it's on a Friday or a Monday, like shake it up. And so we want to really catch them doing something good versus catch them doing something bad. But if they know that we're going to be intimately involved in the success and the daily interactions they have on that site, and we're going to be constantly checking on them, they're going to hold themselves to a higher standard. Because if you are kind of lazy about it, they're going to be lazy about it. It's just human nature. They're not going to have a gold standard if you don't have a gold standard. So keeping to that has really allowed us to outperform the market.
One thing I want to clarify and differentiate for some people that might be newer to this space: once you get into commercial real estate, you don't have to be the one managing a deal. If you're buying your first single family home, second single family home, you're likely the manager, maintenance, everything. With these larger deals, you hire companies. Now, some people have them in-house. You guys use third party, which is nothing wrong with it. Just find what works for you. And so it's important to point out that even though you're not the one doing the day-to-day management on the property, you still have to manage the managers. Because to your point, they'll take whatever you give them. And if you never check in with them, you got to have those standards. You got to have that accountability. And that's one thing that I've noticed that you and your team do very, very well. And those surprise check-ins, those drop-ins, you probably secret shop some of your deals as well to see how they're performing. So that management piece, we talk about this all the time. I'd love to get your thoughts on this. One of the biggest mistakes that I've seen people make, newer to passive investors investing into deals, they get sold on the deal itself. They weight about 80% of their decision on that deal. The pictures, the pitch deck, not experienced LPs, like that. Obviously this doesn't apply to them, newer people. And what we share and what we have found is that if you spend about 80% of your time vetting the operator, 10% vetting the market, and then the remaining 10% vetting the deal, now you're setting yourself up for success, where people might have that flipped. Some people might say, hey, this is a beautiful deal. Nothing can go wrong with it. It's in a great market. Even with a bad operator, I still believe in the deal. And I think you and I know that that's truly not the case. So that's how we view it and prioritize it to anyone. If you're looking to get into a deal, spend 80% of your time vetting the operator, then the market that it's located in. And because in our mind, that's how you stack the deck. And then that operator or the deal at the end, it's less important, because in our experience, you can have phenomenal deal with a bad operator and they could drive it into the ground. Or you could have a good deal, an okay deal with a phenomenal operator and they're going to hit a home run with it. So that's our view. That's our thoughts on how people should prioritize their vetting process, but I'd love to hear yours around that.
Yeah, 100%. I think that's why so many people got in trouble the last few years, where you had all these different people jumping into real estate for the quick buck and had no idea on what asset management was or running.
They just know Uncle Jimmy invested 18 months ago and doubled his money.
Yep.
And so they're looking for that quick money.
Yeah. I mean, I've lost out on so many investors where they're like, well, you're offering 16% IRR and someone's offering 18. I'm like, these are projected numbers, first of all. And I could tweak my underwriting to make it look like 35. That doesn't mean anything. Or I've lost, investors to like, I'm getting, 97% bonus appreciation on one deal and you're offering 90%. Those percentage points mean nothing. And quite honestly, as an investor, I've made some stupid mistakes too, where I saw a deal a friend brought to me and it was like 25% IRR on a development deal. And my thinking was, okay, if he doesn't hit 25, he'll hit 20 and I'll be good. And, I didn't do enough due diligence on the person. I looked at the deal, exactly what you said, and I lost all my money. So, here I'm trying to justify that I'll still make 20%, and I lost all of my money because of that. And so, the operator is everything. You really got to understand, have someone that is experienced, has done deals in that market before. If not, have they built up thousands of data points in that market at least? All these different experiences. Have they gone through up cycles and down cycles? Because the frothiness of an up cycle, it'll suck you in, and if you don't have that experience of a down cycle, you'll definitely make mistakes.
I was attending this fund symposium, and it was a workshop, a training on how to structure funds and raise capital compliantly. And the gentleman hosting it has raised millions of dollars. And we were talking about underwriting and sourcing deals. And he said, I've got so good at underwriting that even I started believing the numbers. And that's stuck with me for years, because that's a reality of it. Like, you can tweak. You and I know what two numbers we can tweak to make that look like a home run.
Yeah.
The average person wouldn't. The first time investor would have no idea. So it's the underwriting. It's good. It's a projection though, and I think that's what people need to understand. It's a projection. Now, what's the track record of that operator? How much experience do they have? Have they gone into similar deals like this? Have they operated them successfully? That's where the money is made, is in the operations. And you and I have seen this over the last few years. A lot of people entered the space and they start raising capital and they start buying deals. And I get it. Like, you have to find partners initially when you're getting started, and a lot of times those partnerships don't work out. My initial one didn't work out. Yours didn't work out. It's okay. Like that. It's normal. Right. It's part of business. But those are things that you need to be looking at as a potential investor. Is how long have they been doing this? How many deals have they done? Do they have that track record? Because the money is made in the operations of the deal. And in our space, we know people that got started, and it's like they found the deal from the broker, they raised the money, they close, and it's like, we're done.
Right.
It's like, no, you just completed 5 to 10% of the business plan. Yeah. But people get that high. They feel like they're professional investors now, operators, because they buy that deal, and then they realize what really goes into the day-to-day. So as you guys have effectively operated these properties over the last few years, not to say that there may not have been any challenges, everybody has, but what are some key things that you really look at in the operations to make sure the business plan is still moving forward?
One, speed. Things are never done as fast as I want it to be done. But like when you take over a property, whether you're updating the landscaping or adding these amenities and whatnot, let's go. Let's get that all done right away. Particularly the exterior, because if the exterior is nice, then the resident feels proud of where they live, and then they'll rent the place even if their unit isn't as nice. retention is key because it costs you so much money to spend time and energy leasing up the unit, and also having to renovate it. You know, if someone moves out, you have to update the carpet or the floor paint and all this other stuff. So retention is key. Obviously, you want to keep delinquency down. So not just filling up the apartment complex, but making sure you're having good residents in there, and not just like, oh, okay, then they can't afford the rent, and they haven't done enough background check to make sure that they can afford it over a consistently long period of time. Having good staff goes a long way. Much better to pay a little bit more. It'll pay off in the long run to have someone long term, and that's going to go that extra mile. It's so important. Turnover just kills your property, and it's not, you get someone in there and then there's 2 months of cleanup from what the bad person that just left, all the invoices that were in the bottom of a drawer or whatnot like that come out every single time, So having good staff, setting a really good standard from the beginning with that team as well, and making them feel. We really work hard on making sure they have ownership thinking, which is they're involved in the decision-making process. Just because we own the property, they're there on a daily basis. I want to know what's working and what's not working. I can't make that decision. I want that feedback from the people that are there every single day, and make them feel that they're greatly appreciated, because property management is a low margin, unappreciated job. From the maintenance team to the office staff, usually people want something fixed or complaining about something, and so it's tough, and you got to make sure that they feel appreciated, because they're representing you, the owner. So those are for us the key things that we're trying to achieve.
I've never understood. I mean, property management is probably one of the most important and critical things in operating any real estate deal. So it's always blown my mind as to why it's one of the thinnest margin business. It's one of the most important, but it's very system and process heavy, people heavy as well. One of the things that I want to highlight that you talked about is helping your staff have decision-making choices, right? Like being participating in those decisions. Now, you're going to have the final decision at the end of the day, but that respect, just saying like, hey, you're here every day. What are your thoughts? It goes so far with people. People at the end of the day, and this goes for tenants too, they just want to feel recognized, appreciated, valued, like at the core of who we are as human beings. That's it. And one of the misconceptions that we're trying to show and hopefully disprove to some people is that real estate can be a very good business to serve in. It can be, you can make a big impact, not only for the people that work for you, but for your tenants too. I know landlords and property owners in general get a very bad rap because unfortunately there are a lot of them out there, a lot of those slum lords that are just going to jack up your rent, not take care of the property. And so being able to get a good operations team in there, good staff, take care of the property, take care of the tenants, it's a very rewarding business. And then your investors, you get to invite them to come along in that journey with you. So it's helping them see what they're doing at the properties. And I know you guys have done this. We've toured some of your properties with you. We know a couple other operators. They'll invite people out to tour the property so investors can see what's actually happening. And I think that goes such a long way. So as we start wrapping this up, Gary, and really appreciate you coming in and sharing your thoughts with us and your experience. If you were to look back and when you got started, knowing what you know now, say you were talking to your new investor self 6-7 years ago, what's one nugget that you would share with them in regards to being more effective and efficient with raising capital?
Invest more. Well, just share the I think people don't realize how much this rocket fuels your net worth, the tax benefits of real estate. It's a huge advantage over other investments. So people, shouldn't sleep on the tax benefits. That would be the biggest thing, I think.
So going back, with that being said, if you going back 6 years ago to when you started, do you feel like you would have spent or would spend more time educating people on that?
Yeah, absolutely. On the bonus depreciation, and I mean, you like I said, you can invest $100,000, get almost like $100,000 loss on your K1, and you can use it against other gains if you sell your stocks or whatnot, or carry it forward. Just you take that supposed IRR projection of 16%, and it could double just on the tax benefits. It's huge.
Yeah, and I think that's something that's severely overlooked and not communicated well enough to potential investors. And again, we don't know what we don't know, right? We see as capital raisers, as business owners, as real estate operators, we see the potential in things in these properties that others don't. It's our job to be able to convey and communicate that message to them accurately. And I think what you shared is huge. Like, even if you're projecting an 8% return on their money, but there's all these tax benefits, at the end of the day, they could easily be up in the double-digit return without having to pay tax on it either. So I think that's one of the things people need to realize. And we don't need to know it all. That's why we have good CPAs. That's why we have good accountants. And even for that education, those workshops, those webinars, you just invite them on. You invite them on. So anybody, I believe anyone, can host a webinar.
Yep.
Even if you're brand new, say, hey, find a CPA that knows real estate that can talk about depreciation. Pick a date and time. Everybody loves talking about what they do. And so they'll most likely not say no to your invitation. Invite them to be the guest speaker, and then invite people in your network. Like, it really is that simple. I think we often overcomplicate it sometimes. So, well, Gary, really appreciate you coming on. You actually have a special gift for our listener. So would you mind sharing that?
Yeah. If you go to our website, breakofdaycapital.com, or actually email info@breakofdaycapital.com and mention this podcast, we will send you a free copy for the first 10 people. Invest Smart, Spotting Red Flags in Real Estate Syndications. So kind of what Dallon and I were talking about earlier in the show. We'll send you that book that will give you at least 20 red flags on things to look for.
Which is huge, because as we talked about, that's 80% of the deal. And I think people are realizing that over these last couple of years. But real estate's not dead. There's still a lot of good opportunities, a lot of great operators. Gary, you're one of them. Appreciate you coming on the show. And until then, we'll catch you guys on the next one.
Thanks for having me.